questions. So if you do this, I think that we'll be good to go. All right. So having said that, today I have a set of questions for us to look at, and then we'll see how best we can solve them. So I'm going to share my screen so that we can all see the questions. Okay, so let me look at it. Okay, can you see my screen?
Yes.
Okay, so today the questions are going to be on standards, accounting standards, and for financial reporting, the standards questions are pretty much straightforward. So you just need to understand the principles and you are good to go. So let's start with the first question. Okay, so I'll 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 request that someone read a question for us. So if someone can read for us, as you are reading, you are also it's a way of understanding the question. Okay, so anyone to volunteer for us to read for us? Okay, so let me read.
We are only seeing your picture. The question is,
The question is not showing. Okay, I'm coming. Just a moment. Is the question showing now? Can you see the questions now? Ha, you still can't see. Or you can see. Hello, can you hear me?
so it's now on. We can see now.
Okay, very good. Okay. So just a moment.
So question one, Ghana aims to. Oh, it's gone.
Okay, sorry.
Okay, it's back.
Okay, so you can go ahead.
Question one, Ghana aims to achieve its target of 10% of its total energy consumption coming from renewable sources by 2028, in line with has recently extended subsidies to businesses that make solar farm investments, motivated by this government assistance. Mitumi PLC, your employer, has lately joined the solar energy industry. In March 2024, Mitumi PLC installed and paid for 600,000 of property, plant, and equipment PPE on a farm. The PPE will be depreciated over 25 years. In July 2024, the government provided a grant of 40% to the company towards this PPE. The company's depreciation policy is to charge a full year's depreciation in the year of purchase and none in the year of sale. So,
Okay,
sir, please, you have to go up.
okay, correct.
So, required in accordance with IAS 20, accounting for government grants and disposal of government assistance. Explain how a repayment of a government grant should be accounted for in the financial statements. II. For each method of presenting a government grant in financial statements, provide the journal entries based on the information.
Okay, very good. So this question is on what? Government grants. Okay, IS 20. Are we familiar with this standard? I mean, have
Yes,
you?
sir.
Okay, good. Okay, so yeah, so we are familiar with the standard. So it's yeah. So let's try and break this question down. All right. So Ghana aims to achieve a target of total energy consumption coming from renewable sources. Because of this sustainability reporting and sustainability practice. Now um, we are all trying to reduce the level of what's the name, carbon emission in our environment. So we are trying to adopt renewable sources of energy. So this is something that is ongoing. The world is moving towards sustainability. Okay, trying to um, try not to pollute the environment, trying to engage in practices that will protect the environment. Yes. So government. So per the question, Ghana has a target to achieve certain benchmark, sustainability benchmark. All right, and it is in the renewable energy industry. Okay, they were trying to achieve certain sustainability benchmark in the renewable energy industry. Okay, so the government is also trying to encourage other businesses to embrace or to adopt sustainability practices in their businesses. And the government had decided that they are going to provide subsidies for companies who try to adopt um, solar energy, or um, who try to adopt clean energy in their business, maybe the use of solar panels, in their businesses. So now there's this company who want to take advantage of this opportunity, because government is giving subsidies for um, companies or businesses who are using renewable energy sources. Yeah. So this company called Mean to Me Limited PLC. Okay. Also has it's in the solar energy industry. Okay. And they have Mean to Me industry has purchased 600,000 worth of PPE on their farm. Okay. So they have a farm and they purchase this asset. I don't know what type of asset it is. It may be solar panels, or it may be a asset that generate some renewable energy. Okay. And the question went on to say the asset is depreciated over 25 years. So we need to depreciate assets. Once we purchase an asset, we need to know the useful life, and we have to depreciate the asset. So this asset's useful life is 25 years. Okay, so they bought the item on March 2024, and the government gave them a grant in July 2024. They gave them 40% of the cost. Okay, so the government paid or gave them a subsidy of 40% of the cost of the plants. Okay, the company's depreciation policy. So this is the depreciation policy of the company. The company depreciation policy is to charge a full year depreciation in the year of purchase and not in the year of sale. So what this means is, um, irrespective of the month in which they bought their PPE, they are going to charge the full year depreciation in the year of purchase. So let's say 2024. So from January to December. And assuming they bought in the question they bought the PP in March. So let's say March is here. Okay. So ideally they should depreciate from here to here. From the time they bought it to the end of the year. Okay. But their policy says, once they purchase the assets, they are going to depreciate the asset full year, irrespective of which month it was purchased. Yes. And then when they come to sale of the assets, okay, assuming that they bought it 2024, they sold it 2026. Maybe they sold it in maybe November. Okay, I think November is, let me, okay, so let's say um they sold it in March. Maybe this is March. So we have December here, January here. So they sold it here. So ideally they have to depreciate from January to March. But the standard says that in the year of disposal or in the year of sale, there will be no depreciation at all. So that's what this this statement is trying to say. Okay, is their depreciation policy. Every company and how they intend to end their depreciation policy. All right. So, okay, now let's look at the question itself. Okay, so let's look at the question. It says explain how repayment of government grants should be accounted for in the financial statements. Repayment, accounting for repayment of government grants. Who can help us? Anyone? So this is a tutorial class, so we have to discuss. So what do you think? How do we account for repayment of government grants? Anyone to help us? Hello, are we there? Are we around? Hello.
Yes, we are.
Okay. Can we help us with repayments of government grants? How do we, if you remember? Okay, any idea? Okay. So ideally when government gives a grant, they don't expect the company to pay back the grant. But there are some instances where the company or the business may be required to pay the grant. pay back the grant. And this happens if the the business or the entity does not comply with the what's the name, with the rules of the grant, or that does not comply with the requirements of the grant. You know, every grant has a purpose and certain requirements to be met. So if you are given a grant and you don't comply, you use the money for a different purpose instead of using it for the purpose for which it was given, the government can ask you to pay the grants. So that's what we call repayment of government grants. So if we are asked to repay the grants, how do we account for that repayment? So that is what this question is trying to say. So to understand or to know how to account for repayment of government grants, we need to know how government grant is accounted for in the first place, like how we recognize government grants before we can even think of repayment of government grants. So we have two types of government grants. We have capital grants. Okay, and okay, who can tell us what capital grant is? Then we have revenue grants. All right. So who can help us with capital grants? What is it? So this is a revision class. So this is a tutorial class. So I I assume that we are
Okay.
are familiar with the
From my understanding, the capital grants are on the PPs, that's property, plant, and equipment, as they those that we can touch and then feel,
okay,
or we say, yeah.
okay, yeah, okay, that's good. Yeah. So capital grants is a grant to purchase PPE. So in the question that we are uh, in the question that we are treating, it's a capital grant, isn't it? Because they use the money to buy PPE. They use a grant to, or the grant was a subsidy for purchase of PPE. Yeah, and then we have revenue grants. So revenue grants are grants for day-to-day expense. They are grants to cater for day-to-day expenditure of of the business. So maybe payment of salaries, maybe administrative expenses. So those are revenue. The government can give a grant for just for the running of the business, not to purchase assets, but normal business expenditure. Okay, those are revenue grants. So the we need to know how capital grant is accounted for, you know, and how revenue grant is accounted for. So when we receive a capital grant, how is this accounted for? Anyone to help us? So capital grant, when you receive a capital grant, how do we account for it? Okay, so for capital grants, there are two ways of going about it. Okay, so let's say that um, so in our let's use our question for instance. So the grant is 40. The cost of the PP is 600,000. and the grant is 40%. So how much is 40% of 600,000? So how much are we going to get? So um, 40%.
240,000.
Okay, we'll get 240,000. Yes. So the grant is 240,000. Okay, there's a grant, and there's a cost of the asset, and they receive a grant of this. Okay, so there are two ways of accounting for this money. Okay, for capital grant, the first one is called the deferred income approach. We call it deferred income. Deferred income approach. Okay, so what does it mean? Okay, now let's do a very simple double entry. Okay, so the business has received 240,000 as grants. So this money has hit their accounts. Okay, because they had already purchased this assets. They paid for it already, and later the government gave them this money. So when they receive the money, how would they record it in their accounting system? Okay, assuming the money hit their bank account, so we debit the bank, isn't it, of the 240,000, because the money has hit the bank account. Then we have to credit an account. So the account we credit is called a deferred income. Okay, it's deferred income. So what is deferred income? Deferred income is an income that we expect to utilize in the future. Okay, we expect to utilize that income in the future. Even though we have received the money now, okay, it's sitting there. We are not using it at the moment. So we are expected to, or we are expecting to use it in the future. Okay, so when the grant comes, we record, we debit the bank, we credit the deferred income account like this. Okay. Now this grant cannot be in the bank statement, cannot be in the balance sheet forever. It cannot be in our books forever. You know, it's this deferred income is in the balance sheet. Okay, so notice very well. This goes to the balance sheet. All right, so it will not be in the balance sheet forever. It has to eventually disappear. Okay, just like when you purchase an asset, the way we depreciate it every year, so that by the end of the useful life, the asset is taken out of the books or out of the account. Okay, so the deferred income also, we have to what we call amortize it, okay, over a period, so that by the end of that period, we'll have a zero balance in the deferred income. So the standard says that whenever we s- we recognize a government grant, capital grants, okay, it should be treated as deferred income, like what we've done here. Okay, and it should be amortized over the useful life of the related assets. Okay, it should be amortized over the useful life of the related assets. So in our case, we we purchase the assets. Where is the question? In our case, this is the cost of the asset, and it has a useful life of 25 years. Okay, so it means we are going to amortize the grant over 25 years. So when we say we are going to amortize the grant, we mean that we are going to break this grant into 25 equal parts. So 20, so it will be 240,000 over 25. Okay, like this. So every year we are going to reduce the amount, the balance of the grant by this amount. Okay, every year. So by the 25 years, by the 25th year, this balance will be zero. And that's what it means. So every year we reduce this by this amount. Every year we reduce the grant by this amount. Okay. So 240,000 divided by 25 will give us how much? So 240,000 divided by 25. That will be 9,600. Okay. So every year we'll amortize the grant by 9,600. Do you get it? Okay. And then we also depreciate the asset. So let's say year one. We are at the end of year one. Okay. So let's say end of year one. Okay. So let's say 31st December, the first year. What we'll do is we'll have to calculate the current amount of the assets. Okay, so we have the cost, which is the 600,000, and also we have the depreciation, which is the 600,000 over 25. Okay, 25. So how much are we going to get? So that'll be 24,000. So we have the current amount. 576,000. So at the end of year one, this will be the current amount of the PPE. Okay. Then we look at the grant too. We go back and check the grants. So the grant also, okay, the grant is, how much was it? 240,000. Okay. 240,000. Then we amortize it by 25 over 25 years. Okay, so it will be 240,000 over 25 years. Okay, so how much? We'll get 9,600. So 9,600. So what will be the balance of the grant? So that'll be 240,000 minus 9,600. So that'll be 230,400. Okay, so this will be the balance of the grant at the end of the first year. Okay, so this amount will go to the balance sheet. This is what we show in the balance sheet. This amount, this amortization, will go to the P&L. Okay, as amortization of government grants. Okay, when we look at the asset to this amount, the current amount will go to the balance sheet. Then this one is the depreciation, which will go to the the P&L. Okay. So in our balance sheet, this is how the presentation will look like. Okay. In our balance sheet, we should we should and our non-current assets. Okay. And our non-current assets, PPE, which is the asset that we purchase. We recognize the carrying amount, which is the 576,000, like this. Okay. Then, so this is the current, this is under assets. Then we will come down to the liabilities. Okay. Under liabilities, we recognize deferred income. Okay, which represent the balance of the grants. Okay, which is this 230,000, 230,400. So this is how the balance sheet presentation will look like. Okay. Then when we come to the income statement, the income statement, okay, they are going to be two items, okay, that will show in the income statement. Okay, they are the depreciation, okay, the depreciation that we calculated, which is the where is it? This one, 24,000. So depreciation of 24,000. Then we have the amortization of the government grants. So this is an expense in the income statement. Depreciation is an expense, okay, and the amortization of government grants. This is this will be an income. Okay, this is going to be an income. Okay, so that's how the capital grant is accounted for using the deferred income approach. Do you get the deferred income? Now, when it comes to repayment of grants, if you are asked to pay the grants, what happens is probably um you may have time might have gone by since you were given the grant. Maybe 2 years later or 3 years later, you are then called to pay the grant. Okay, it means that at the time that you are called upon to pay the grant, you would have amortized part of the grant. Okay, so when you are asked to pay the grant, we have to do what we call reversal. You have to reverse all the amortization of the grant. Okay, because you are supposed to pay the grant, so all the amortization that you calculated before you were asked to pay the grant, you have to reverse it because it doesn't hold again. You are told to pay the grant. Do you get it? So repayment of grants, it is accounted for according to the standard. It is accounted for as a change in accounting estimate. Okay, it's a change in accounting estimate. What it means is that the amortization is an estimate. The amortization that we have been calculating is an estimate. So when you are asked to pay back, okay, we have to go back and reverse all the previous amortization that we recognized. Okay, so that is, and we also have to what's the name? We also have to clear the balance of our deferred income. If there's any balance of our grants, we have to clear it in our balance sheet. Okay, so I think that an example will help us to understand this. Okay. So let's say that in our question, okay, at the end of the first year, this is the balance of the grant, 230,400. Okay. This is the balance of the grant. All right. And now the government says you should pay back the grant. So if you are to pay back the grant, what will be the double entry? Okay, that's the first. Always think about start thinking from the double entry angle. It will guide you as to how to approach the solution. Okay, so you are asked to pay the grant. Okay, now if you are asked to pay the grant, obviously money will go out. Money will there will be outflow of money. Okay, your cash flow will be affected. It means you have to credit your bank account. Okay, by how much? By the amount of the grant. You see, 240,000. You see, because they have asked you to pay the grant, so you credit your bank 240,000. Now, what do you have to debit? So that's the question you have to ask yourself. Okay, we know that once we are asked to pay, we will credit our bank account to be affected, whether cash or bank. Okay, it's going to be what's affected. We will have to credit the bank, but we have to debit an account. Okay, so what account are we going to debit? Okay, we are going to debit the deferred income account. This one, you see, so that we'll clear this. This is a liability, and a liability has a credit balance. So to clear this balance, okay, we have to debit it. Okay, so we have to debit the deferred income. Okay, by how much? 230,400. But it's still not balancing. There's still a difference. There's a difference of how much? I think 9,600. There's a difference of this. Okay, 9,600. So this is going to be what's the name? It's going to be a reversal of the amortization. Okay, it's going to be a reversal of the amortization of the government grant. Okay, this will be in the so this will be an expense. Okay, in the P&L. All right. So that's how we account for repayments of government grants. Okay, capital government grants. So you credit the bank. You have to clear the balance of any deferred income or any deferred income of the grant. You have to clear it. Then any all the previous amortization of the grant, okay, you have to reverse it. Okay, so it's in other words, we are doing a reversal of everything because we are asked to pay the grant, so we need to reverse the amortization that we had calculated in the past, and also reverse the deferred income balance in our balance sheet. All right, so that's how we account for repayment of government grants. Okay, I hope I hope we understand the principle. Hello, are we there? Oh, it's confusing.
Yes, please, we are. We understand it now.
Okay, very good. Yes. So when you ask to,
Yes. Yeah.
okay, wow, then that's very nice. I'm happy you understand you understand you understand it. Oh, yes. So let's go back to the question. Okay, so explain how a repayment of government grant should be accounted for in the financial statement. So 3 marks. So what you say is that this is a capital grant. Okay, based on the question, it's a capital grant. So we have to recognize any deferred income balance. Okay, or we have to clear the recognize means to clear the balance, any deferred income balance. Okay, that's one. Then we also have to reverse any previous amortization of the grant. Okay, we have to reverse, yes, and also we have to credit our bank or our cash. Okay, so that's the explanation you will give. Okay. Then number two, for each method of presenting a government grant in the financial statement, provide the journal entries based on the above information. Provide the journal entries based on the above information. So based on the information we have, okay, we we have received a grant of what was the name? We have received a grant of 240,000. Okay, so when we receive the grant, the journal entry is going to be we are going to debit our cash, our bank, okay, by 240,000. Okay, then we are going to credit the deferred income, okay, of 240,000. Yeah, so that's the journal entry that we have to pass for the receipt of the grant. All right, okay. So let's look at the next question. Okay, can somebody read the next question for us? Okay, so I'm reading. IS2 inventories prescribes the accounting treatment for inventories. It provides guidance on the determination of cost and its subsequent recognition as an expense, including any write down to net realizable value. Mrs. Christina Addo, the managing director of Malik Limited, has a number of specific queries in relation to inventory and has asked you for professional advice in relation to IAS 2. Malik Limited closing inventory at 31st December 2024 is 345,000. This includes 4,600 of the items accidentally destroyed on 31st December 2024 after the count was completed. Also included is 2,900 cedis which relate to the cost of inventory damaged in October 2024, which can be reworked at a cost of 600 cedis and which can then be sold for 2,400. Okay. Required. Identify four situations in which realizable value is likely to be less than the cost. 2. Calculate the closing value of inventory at 31st December 2024 and show how it should be accounted for in the statement of financial position and the statement of profit or loss. Okay. So this question is under IAS 2 inventories. I hope we are familiar with inventories, right? Are we familiar with inventories? IAS 2 or not? Hello, are we there?
Yes, Maxwell. Yeah.
Okay, very good. Yeah, so IAS 2 inventories is the accounting standard that regulates or that yes, that regulates how inventory should be accounted for or how inventory should be recognized in the financial statement. Okay, so whenever you are recognizing inventory, you have to follow the principles of IAS 2. Okay, so according to IAS 2, inventory is an asset. We all know it's a current asset. Okay, it's a current asset, and we know that inventory is carried at the cost. Like ideally, in our balance sheet, inventory should be at the cost. The current amount of the inventory should be the cost we purchase the inventory at which we purchase the inventory. Okay, so if we bought inventory of 20,000, okay, in the year, and at the end of the year, that inventory is still sitting in our warehouse. Okay, it means in our balance sheet, okay, under our current assets, in our balance sheet. So in our balance sheet, okay, under our current assets, okay, we will recognize inventory. Okay, that's the cost of 20,000. Assuming this inventory is still in the warehouse, it has not been sold or it has not been used. Okay, so that will be the cost. Okay, but there are some situations or there are occasions where we don't recognize the inventory at the cost. Okay, but at the net realizable value. So when we say the net realizable value, it means how much we can get out, how much we can get from selling the inventory. Okay, and this comes in when maybe the inventory is damaged. Okay, or maybe there's a problem with the inventory. So um we there's a problem with the inventory side that even the inventory value is less than the cost. So let's say that we have this inventory of 20,000, but part of it, let's say they are perishable materials. Okay, and let's say part of it is damaged. Okay, and now the value is now 15,000. Okay, so even though we bought the inventory at 20,000, but because some of them are destroyed or damaged, we only look at the actual value. Oh, sorry for the interruption. Yeah. So let's continue. Yeah. So ideally, inventory should be carried at a cost, but due to some, like I mentioned, sometimes due to some circumstances, the inventory value may be less than the cost. Okay, that is where we use the net realizable value. Okay, so the net realizable value is how much we are going to get from selling or disposing the inventory. Okay, so the standard says inventory should be measured according to IAS 2. Inventory should be measured at the lower, like at the lower of the cost and the net realizable value. Okay, so it's measured at the lower of the cost and the net realizable value. So if the cost of the inventory is 20,000 and the net realizable value is um maybe 12,000, okay, it means that we are going to use this. This is what will show in the balance sheet. Okay, okay, and it means that this inventory, okay, there's going to be a write off of 8,000. Okay, this is going to be like a write off. Okay, because we bought the inventory at 20,000, which is like a cost to us, but we are now reducing the value to 12,000. So this is like a right. This is like a write off. Okay, which will go to the P&L. So anytime inventory is measured at the net realizable value, there's going to be a write off. Okay, of of a certain amount, which will go to the profit or loss. Okay. So with this understanding, let's go back to our question and look at. So we are told that at the end of the year, the total inventory was 345,000. Okay. So 31st December, okay, the inventory was 345,000. That was the total inventory. Okay, let's continue. Okay, so they gave us some additional information. So this 345,000 includes 4,600 for items accidentally destroyed on 31st December. Accidentally destroyed on 31st December after the count was completed. So, you know, at the end of the year, we have to do stock count. You have to count the inventory in the warehouse or wherever the inventories are located. So they are saying that during the count, when you are counting inventory, if you are not careful, if you don't take your time, you can some of the inventory may be destroyed because you have to be moving the boxes, moving them here and there. So in the process of moving the inventories, some can be damaged. Okay, so they are saying that this amount got damaged. So if it got damaged, we have to take it out of the total cost. So less the damage inventory. So when we take the damage inventory from the total cost, how much are we going to get? Three four 345,000 minus 4,600. So we are going to get 340,400. Okay, so let's continue. Also included is 2,900, which relate to cost of inventory damaged in October 2024. So there were also some inventory that were damaged in 2024. But this inventory, they can work on it. They can rework the inventory at a cost of 600, and it can be sold for 2,400. Okay. So this information is to calculate the net realizable value. Okay, the rework, and then what's the name? And then the sale. Okay. So the net realizable value of this inventory is is the uh, is the proceeds minus the cost to sell. Okay. Okay. So that's the cost to sell, or maybe additional costs. Additional costs on the inventory to make it available, ready for sale. Okay. So the proceed is 2,400, and now we have to do some work on it, which will cost us 600. Okay. So at the end of the day, our net realizable value will be how much? 2,400 minus 600. How much are we going to get? Okay, so we are going to get 1,800. Okay. So what it means is that this 2,400 is inside this amount. Okay. But we are only going to recognize 1,800. 1,800 of it. Do you get? So let's do a very simple. So the inventory is this. Okay. This is the inventory that was damaged. And the net realizable value is 1,800. So how much are we losing? How much are we taking out? It means that we have to take out. Okay, we have to take out 600 out of it. Okay. Hey, sorry, this is a cost. So this is a cost. And that's why it was confusing me. Yeah. So the cost of the inventory is this 2,900. Okay, 2,900. But we are only going to recognize 1,800. Okay, because that's the net realizable value. Okay, this is the net realizable value, and this is the cost. So it means we are going to lose how much? 2,900 minus 1,008. So that will give us how much? So it's going to be 1,100. Okay, so that's a write off. Okay, that's a write off. We are going to reduce the inventory to this amount. So we are going to reduce the inventory by 1,100. So when we come here, we reduce the inventory by 1,100 here, which is the write off, inventory write off. Okay, so at the end of the day, our closing at the end of the day, our closing inventory is going to be 339,300.
More Samarinda.
Okay, that's going to be our closing inventory. Okay, yeah. So that's how we approach this. Okay, that's how we are going to approach this question. So we have solved the II, which is the calculation aspect. Let's look at the I. Say identify. Okay, so let's look at the I. What's the name? The I. Say identify four situations in which net realizable value is likely to be less than the cost. Okay. So what are the situations that will cause the net realizable value to be less than the cost? So this usually happens when the inventory there's a problem with the inventory. Maybe the inventory is damaged, or maybe it has become obsolete. Okay. So let's look at the various situations. One is physical damage. If the inventory is damaged, okay, reduce the it can cause the net realizable value to be less than the cost. If the inventory has deteriorated, okay, deterioration of so if inventory is kept for long without using, so it can deteriorate. Okay. Then if the selling price of the inventory fall, if there's a fall in the selling price, okay, it can also cause the net realizable value to be lower than the cost. Okay. Fall in the selling price. Then the last one. If management decide to sell the inventory at a loss, management can decide to sell, maybe they are doing promotion. So they can decide to sell the inventory at a very low price. Okay. So to the extent that they will be making losses. Okay. So if management decide to sell the inventory at a loss, okay, it's going to also cause the net realizable value to be less than the cost. All right. Okay, so yes, so I think that's it for today. This is supposed to be 1 hour session, so we'll meet next week, or maybe we'll meet before the week ends. Yeah, so every week we'll try and meet and then we'll solve some questions, as part of our preparation towards the exams. All right. So on this note, we shall call it a day. And thank you for joining, Joseph, Mr. Bedu, Patrick, my own boss, Patrick, and Prince.
Yes, Mr.
Thank you,
Michael.
sir.
Thank you very much.
Okay,
We
okay.
also thank you for your time.
All right, sure, sure.
Yeah.
Okay.
See you.
Thank you so much, Maxwell. We appreciate your time.
Okay, thank you. All right, thank you. Okay, yeah.
Bye.